Okay, module 1. Can you hear me, everybody? Yeah, good. Okay, we will look at objectives of financial reporting, the principles of accounting, and understand what accounting equation is. And then we will sort of simulate a couple of transactions to see what is the impact in respect of the business, and just go through some of the areas of who are the users of financial statements. Now, first thing here is, what is the objective of financial reporting? Is basically for you to make some investment and credit decisions. You make a lot of investment decision, how much of money you want to put in as capital when you start your own business, if you are starting a law firm or whatever. And in terms of credit decisions, the bankers use a lot of this information in order to make sure that they are lending to the right party and the sum which is going to be lent out in terms of loans or whatever. Or even if you go and have any kind of dealings with any of your customers, you want to make sure that you want to assess the credibility of the customer. All right. So accounting gives you this, and financial reporting helps you to make those decisions. It also gives you an idea of what is your future cash flows going to be. All right. You have some historical information of what's happening to your business in terms of how much of income is coming in, how much of expenses you are incurring. From that, you will be able to assess what is your future cash flows going to be, all based on how much a credit period you are allowing to your customers or your clients in the law practice, and how much is your suppliers giving you in terms of credit. So that will basically, you'll get a basic understanding of what your future cash flows are going to be. And then you want to identify what your assets are, which are your economic resources. What are the claims against those resources? Basically, in every business, there are assets, there are liabilities. All right. So you want to make an assessment, identify what those are at the end of the period or what. All right. So very briefly, this is really what the objective of financial reporting is. So in a business or investment, if you're in law practice, all right, you will be running your business. And what is your ultimate objective is to sell your services, all right, which you charge your fees. At the end of the day, you want to end up making profits. That's really the decision about this. So in order to identify whether you're making a profit or loss in your business and how your profitability is going to be, whether it's your past profitability or your future profitability, financial reporting helps in terms of managing this and giving you an idea where you are heading towards. The first line item in an income statement normally is revenues. Revenues could be you are selling products or you are selling services in the case of your law practice. So that's your first item on your income. So in order to derive your profit, and then you will knock out all your expenses of your business against those revenues, and you will end up, if your revenues are more than your expenses, it's very simply profitability. If your expenses are more than your revenue, very simply, it's a loss. Okay, so it's very fundamental, easy to understand. You don't. This is very logical. It's not really accounting altogether. It's basically logical. The focus of accounting. So, what is the focus of accounting? The first thing is to identify what are the transactions which are taking place. You will pay rent. You will receive money from your clients. You will pay your staff salary. You do all these kind of financial transactions. It is identifying this economic event. All right. That's the first stage. The second stage of it is all these economic transactions, which comes in a way of different ways, whether it's income or expenses, it will be recorded in the books. And this is recording of the economic events, which is really fundamentally start from the core of bookkeeping and putting everything into records in your financials, whether it's going to be through a system or whatever, but this is. Finally, once you have recorded, you're not going to be just leaving the records alone. You want to see what's really happening to your business. So you will report and analyze these economic events. So that's the real focus of accounting in a nutshell. So there are three types of financial statements which are mandated by accounting and financial regulatory authorities or even government authorities or whatever. There are, when you want to submit your tax returns or in terms of your partnership in your firm or your whatever business you have, the first thing is an income statement, very commonly known as a profit and loss account or a profit and loss statement. It measures the amount of profits generated by a firm over a given period of time. When they say it's a given period of time, Normally, P&Ls, which is called in a short form P&L, it's for a period of time, and most of the period of time generally follows a calendar period of 1st January to 31st December. Everybody likes to coincide this period using the calendar period because the tax period for assessment also falls in the same uh, calendar period. So it makes it easier in terms of having both common. Next thing is in your financials is a balance sheet. A balance sheet provides a snapshot of firm's financial position on a specific date. When you compare with a profit and loss account, a profit and loss account is for a period of time, usually a 12 months period. Okay. Sometimes you want to see how your business is going. You will cut it into 3 months and see the profitability by quarter or by month. But the balance sheet it shows you the financial state of affairs of a particular company or your partnership or your law firm at a point of time. Usually it'll be the end of the year, which is from 1st January to 31st December is your P&L. On 31st December, you want to see what is your state of affairs. That's how a balance sheet is being reflected. So you have these two particular statements which are very commonly used and very commonly everybody knows the term generally. Then you have another particular statement which is known as a cash flow statement. Subsequently, as we get into a bit more on the accounting principles, you will later understand in a company or in a partnership firm, profits does not equal to cash. Neither to loss doesn't equal to cash. All right. So you need to understand in terms of cash flow statement, how did the money come into your business and how did the money get used up in your business? A cash flow statement details this out. So these are the three principal financial statements which are used in all businesses, and it's mandated to be provided for when you, if your company is registered with a registrar of companies or registrar of societies or whatever you call it. So you will have to provide this. But commonly, income statement and the balance sheet is the more popular one. A bigger companies use cash flow statement, okay, which is mandated. So when we prepare all these financial statements, which are your income statement, your balance sheet and all, we are governed by certain principles to be followed by, all right? Certain assumptions to be used in preparing the accounts. And we will be looking at those concepts, which are the fundamental principles of accounting, which needs to be used when you are preparing. If you don't have these ground rules, things will be running in a different way. So these are the fundamental principles to be followed. The first principle to be followed here is the business is accounted separately from its owner, business entity principle. When you are in your law firm, I'm sure in your law firm, your practice or your partnership you have in your law firm, you have a lot of expenses which are incurred. And one of the fundamental things is you need to separate those expenses which are personal to you and the business expense. Business entity principle is one particular principle. You got to separate the owner or the owners away from the business. So if you have your wife going to, or your husband going to the market to buy some marketing stuff, you can't bring it into your financials in your law firm, all right? So you got to keep all those personal expenses, personal income, everything has to be separated. So that's one particular principle which we need to follow, which is known as the business entity principle. Objectivity principle, this is very important. Financial statement information is supported by independent and unbiased evidence. When you look at, if you look at any of these accounts which are prepared and published, at the end of the accounts, it is certified by the auditors, and one of the important statements they put down there, this financial statement has been prepared and provides a true and fair view. Have you seen it before? You go to any of the public listed company which is available on the public domain, you can see it, true and fair view, because it has been prepared independently and with unbiased evidence. You should not have compromised any kind of objectivity, all right? Because it will not be providing objectively the state of affairs of the company, all right? This is very important. And obviously, the tax department wouldn't allow you to do this anything otherwise. Cost principle. That's another particular fundamental concept which we follow when we prepare the financial statements. Financial statements are based on actual costs incurred in the business transaction. How much did you pay to buy the item will be recorded as an expense. For instance, if you buy a particular property, say you buy a property for your business, all right, and it's a business property, you paid 1 million ringgit. That's what you paid for, that's your cost. But the market value of the property could be 1.2 million ringgit. All right, but you are not going to be recording it at the market value because the transactional cost was 1 million. That's what the cost principle says. You got to be recording it at the cost, irrespective of the market value, whether it was higher or lower. You're going to record at what price you paid for it. That's the cost principle. So these are all a couple of principles which govern the preparation of financial statements. Going concern principle. Now, this implies that this company or your partnership, when you prepare an account, you are going to be in operations in the foreseeable future. You're not going to liquidate. It is going to be in existence. Why? If there is any signs that you are not going to be in existence by the end of the year, when you prepare your balance sheet and your profit and loss account, you will be using different values to prepare it for, all right? Say, for instance, I got an example here. In your books, in your financial statement, say you have a motor car with a book value of $80,000 or whatever. But the real market value of the motor car out in the market, if you sell it now, it'll be only fetch $50,000. You will be still using $80,000 because you are a going concern. There is no indication that you're going to close shop. But if there is any indication that you are not a going concern, everything needs to be reflected at the net realizable value of the item or a property. Unbiased means you are not giving fraudulent information, those which have, it is not, there's no evidence of the item or whatever being provided for. Like when if accountant prepares something which is not substantiated with documents or receipts or whatever, it could be unbiased evidence of how it's been prepared. That means that it is being prepared with proper documents and evidence of the proof of payments and whatnot. Net realizable value is, like for instance, in this case, as you're looking at this slide, if in your books, in your balance sheet at the end of the year, you will be reflecting, if you have a motor car for your business, the value of the motor car, book value, later you'll come to something called book value. You'll understand that it is cost minus any depreciation you provided. It is being recorded at 80,000 ringgit. The net realizable value, if you sell this motor car out in the market in a second-hand dealer, it will only fetch $50,000. That's your net realizable value. Okay, so for this case, the going concern, you will be always reporting it at the book value, not the net realizable value, unless you are deemed to be not a going concern, you're going to liquidate your business, then everything need to be reflected at net realizable value.
On the unbiased information, right? Earlier you mentioned that would be information that's backed up by documents, right?
Yeah.
So there's a follow-up question from Tina, and she asks, what if the documents are lost? What can you do to provide this unbiased?
If the documents are lost, it always depends. If I'm an auditor, I will look at the materiality of the amount in the scheme of all things. If your company's business is say 100 million, and if you have a document which is lost and cannot be cited, and you're paid something for 5,000 ringgit, in the scheme of all things, 5,000 is nothing. But if you have something which you have paid for 50,000 ringgit, then you will be having to find a proof to show that what has been, if you don't have the document, you probably got to get acknowledgement for the payment from the recipient of the money or whatever way. You got to find some proof of evidence. Monetary unit principle. So when we prepare our financial statements, one thing we know, it is not prepared in kilograms or different measurements, kati or whatever you call it, but it is always in dollars or ringgit. So every event of those transactions is being denominated in monetary units, all right? That's the assumption, always in dollars and cents, nothing else, all right? Money is certainly the root of all evils, but it is also certainly the root of accounting, okay? Revenue recognition principles, which is very, very important to understand. I think last week you guys stressed the point about this, okay? Revenue is recognized when earned, not just when the cash has been received. That's very important to understand. In your practice, all right, you will, when you bill your client, at the time when you bill your client or invoice your client, that's the time you have earned, you have the right to record that particular transaction as an income in your profit and loss account. If your client pays you some deposit, all right, when you take up the case or whatever, the taking of the deposit is not an income. The time income is only earned at the time when you invoice your client, not at the time when the cash is received. So for instance, if you invoice your client 5,000 ringgit today, all right, which is in the month of October, you will record it as an income in the month of October. But your client pays the money only in December, irrespective, you don't record your income in the month of December. You record it in the month of October and knock it off again what your client owes you in the month of December as cash received against that invoice.
Does this apply to, in some law firms, we take like deposits, right? But even before work begins.
Yes.
And then later on, there's interim billing. So I assume the interim billing is when you recognize per bill how much money.
All right. That's why when you collect the deposit, you are just taking an advance from your client, and you don't recognize that advance as an income yet until you start billing your client, or when you invoice your client, because at the same time when you invoice your client, the service tax starts getting triggered too. Matching principle. This is a very important principle, which is quite close to the revenue recognition. Whatever revenues you get in this period, which is being recorded as revenues, should be matched against all expenses related to that particular revenue. A good example here is you bill your clients, all right, during the year. At the end of the year, for the month of December, you have to pay your rental to your landlord. Say you had to pay a 5,000 ringgit rental for the month of December, and your accounting period is January to December. At the end of the year, you have not paid the money to your landlord, that 5,000 ringgit of rental, but that expense has been incurred. When it has been incurred, it has to be recorded as an expense, even though it has not been paid, because that is the expense by having that rental and that premises in your, which you enjoyed that use of the premises. It helped you to generate income of billing to your client. That's what you call a matching principle, matching, irrespective when you pay the money. These are the fundamental principles of governing the preparation of financial statements.
What if the person invoice doesn't pay, especially in these times where everyone is delaying payment or have just shut down?
When you invoice your client, at the time when you invoice, you will record it as an income. Your client pays you after 3 months or 4 months, maybe it's being delayed. When you bill your client, it will become a receivable from your client and it will be recorded as an asset in your books. Subsequently, when the client pays you, you will receive the money and knock it out against a receivable. If your client doesn't pay you in time and you already have you have sent some dunning notice to your client a couple of times and asking for payments, and you have, it shows quite good indication your client might have a situation with himself or her that they are having some financial difficulties, then you will have to be providing for bad debts. That's what happens. But the income will be recorded when it is the invoice generated. Subsequently, when the client doesn't pay you in time or doesn't want to pay you and doesn't have the ability to pay you, and when you tried all ways of trying to recover the money, if you are not able to recover it, then you will be having to write it off as a bad debt and write it off as an expense in your P&L.